Imagine building a house. Day after day, you stack bricks, lay out walls, and pour your energy into something you hope will last a lifetime. After years of hard work, you finally stand in front of your creation with pride. But then you discover small cracks in the foundation, tiny mistakes made early on that now threaten the stability of everything you've built. Those little errors suddenly become very expensive. That's exactly what happens with investing, especially if you're using ETFs to grow your wealth. ETFs are often described as simple, safe, and transparent, and for the most part, that's true. They are an amazing tool to build long-term wealth. But here's the catch. Even with ETFs, there are subtle traps that can eat away at your returns for years, sometimes without you even realizing it. In this video, I'm going to walk you through the 10 most expensive ETF mistakes that investors make. I'll explain each one in plain English with real-world examples, so you'll know exactly how to avoid them. By the end, you'll be equipped to invest smarter, save yourself thousands, and let your money truly work for you. So let's dive into the biggest ETF mistakes you need to steer clear of. Mistake number 1. Waiting too long to start. It might sound simple, but the biggest mistake of all is just not getting started. So many people spend years in research mode trying to find the absolute perfect time to enter the market. And while they're stuck analyzing, time your greatest asset in investing slips away. Thanks to the magic of compound interest, even small contributions grow into huge sums if you give them enough time. Let's put some numbers to it. Suppose you invest $300 every month with an average annual return of 7%. Mistake number 2, constantly changing your strategy. Picture this, you finally commit to a global ETF, but then you open the news. Headlines scream about the next big thing, and doubts creep in. Should you ditch your strategy and chase the trend of the month? The problem is, constantly switching is expensive. Markets are noisy and move in cycles. If you're always chasing headlines, you'll end up buying high and selling low, the exact opposite of what you should be doing. Think about the AI boom. Many investors reshaped their portfolios to pour everything into AI, but after every boom comes a correction. Stick with a strategy you believe in. Long-term discipline beats short-term tinkering every time. Mistake 3 is switching ETFs for tiny cost differences. One of the reasons ETFs are so popular is their low cost, and fees have dropped dramatically. It might seem like a no-brainer to sell your old ETF and buy a slightly cheaper one. But here's the trap. Selling an ETF often triggers taxes on your gains. Plus, you risk losing money if the market moves while you're making the switch. The difference between a 0.22% fee and a 0.15% fee is tiny. You'll likely lose more in taxes and transaction costs than you'll ever save in fees. Stay loyal to your ETF unless the savings are truly significant. Mistake 4, paying high brokerage and account fees. A lot of investors bleed money not because of bad ETFs, but because of unnecessary fees from their bank or broker. Imagine you invest $300 a month, but your broker charges a 1.5% fee on every trade. That's $4.50 per month. Doesn't sound like much, right? But over 30 years, those little fees can add up to over $5,000 lost. But money that should have been compounding for you ends up in your broker's pocket. The worst part, these costs are completely avoidable. Today, there are plenty of brokers offering free ETF savings plans and zero account fees. Mistake number 5 is falling for thematic ETFs. You see an ETF that invests in renewable energy, AI, or gaming. These themes sound exciting and full of potential, and yes, sometimes they perform spectacularly. For a while, but the reality is, thematic ETFs are bets, not broad investments. You're speculating that one sector will outperform the entire market. Most of these ETFs get popular when the hype is already at its peak. By the time you invest, it's often too late. Your core portfolio should always be diversified with global ETFs. Then, with a small slice of your money, you can play around with themes you're passionate about. Mistake 6. Believing in active ETFs. For most people, ETF means passive investing. But the finance industry started slapping the ETF label on active products too. An active ETF is managed by a team of experts trying to pick winning stocks. Sounds nice. But study after study shows that most active managers fail to beat the market consistently over the long term. On top of that, active ETFs usually come with higher costs. You pay more, but you're not guaranteed better results. Always check if an ETF is passively tracking an index, or if someone is making active bets behind the scenes. Mistake number 7. Investing in ETFs you don't understand. This is a golden rule. Never put money into something you can't explain, yet many people break it when they see a shiny new ETF. Take covered call ETFs, for example. They promise extra income and sound like free money. But these strategies only work well in certain market conditions, and the risks can mount quickly when markets get volatile. If you can't describe how your ETF works to a friend in 1 minute, it's probably too complicated for your core portfolio. Mistake 8 is overcomplicating your portfolio with overlapping ETFs. A common myth is that owning more ETFs means you're more diversified. Not always true. For example, if you own an MSCI World ETF and an S&P 500 ETF, you're essentially holding the same big US stocks twice, since the S&P 500 makes up a huge portion of the MSCI World. You've just added complexity and fees without any real benefit. One global ETF already gives you thousands of companies. Keep it simple. Mistake 9. Paying for currency hedging you don't need. Currency fluctuations can scare investors. If your ETF is in US dollars but you live in Europe, you might worry about the dollar dropping. So, people buy currency-hedged ETFs. Here's why that's usually a waste of money. First, hedging costs extra in fees. Second, global companies like Apple earn revenue in dozens of currencies, so you're already diversified. And third, currencies swing both ways and tend to even out over decades. Skip the hedged products and save yourself the cost. Finally, mistake 10. Stressing over dividend versus accumulating ETFs. Should you choose an ETF that pays out dividends or one that reinvests them automatically? Honestly, there's no wrong choice here. Distributing ETFs give you cash flow, which can be motivating. Accumulating ETFs reinvest dividends for you, which boosts the compounding effect. The difference is marginal compared to the big picture. Investing consistently, keeping costs low, and staying the course. Pick the type that matches your goals and personality. So, those were the 10 most expensive ETF mistakes. If you take away one thing, let it be this. The greatest risk isn't picking the wrong ETF fit, never starting in the first place. Avoid unnecessary fees. Don't chase headlines. Keep your portfolio simple and focus on the long game. You don't need perfection, you just need consistency. Wealth building is a marathon, not a sprint. Each contribution is a step forward, and over time, those steps will give you the freedom to live life on your own terms. Thanks for watching. If you found this helpful, please give it a thumbs up and consider subscribing for more content to help you invest smarter. See you in the next video.